They decay in value every decade dramatically in real buying power because the quantity almost doubles for the dollar, for example, every decade, almost by 90% increase in the supply of dollars. So, like I've probably said this before, when your granddad built a house, it was $4,500 medium home price. Now it's $450,000. Okay, get the point? Okay, another way to express it is 25, quarter of a century years ago, same month, September 2000, if you bought the S&P, you're up 3.5-fold right now, okay? If you bought gold, you're up over 11-fold or 12-fold by now. It's held its value and stayed ahead of the decaying money unit that we use to measure things. Whereas some things have just barely kept up with it, like the stock market. Even though they look good on the price chart, it really isn't keeping up with the real value of the underlying unit. Well, silver was $50 in 1980. Actually, we're going to revise that estimate in a upcoming report. I think it's too low. Silver has already entered an acceleration phase in its trend. And similar events, technical events like that, and they could be defined, occurred back in '79 on the way to the 1980 high, and also in 2010 on the way to the 2011 high. Now, both of those highs were roughly around $50. So everybody in the world knows, silver's hit a high twice at 50. And if you just stand back a bit and think about it, gold's way above its 2011 high. Even copper right now, on this pullback in copper, is still trading above its 2011 high. Metals, like I think I looked at a zinc chart the other day, or was it 10? I forgot. Above its 2011 high. And silver, I guess, is just going to stay below the 1980 high and 2011 high forever. It's a dog. Okay, right. Or something's wrong. Something is wrong with the pricing of that market. And we all know, if you've been in markets long enough, some markets can get overpriced vastly and stay there and yet seem so sane. And then when they implode, you say, oh, golly, it was a bubble. Now I understand. That guy was right, The big short guys, remember, they said they were going to collapse. The mortgages finally did collapse. Or a market gets bashed down so low and stays low for so long that people just write it off. Like it's never coming up. It's mired in mud. It's something's wrong with it. Those can be mistakes, market mistakes. And when a market makes a mistake and finally realizes it's made a pricing mistake, not all markets move rationally, remember, okay? It can often compensate even more so getting back to what it should have done already. Okay. And if you factor in such fundamentals as the real value of the underlying money unit, in this case, let's say the dollar, same applies to the euro and the yen and so forth, fiat pieces, nothing backing them.
A critical factor lies behind the scenes, the erosion of fiat money. As the supply of dollars has ballooned, nearly doubling every decade in some cycles, its purchasing power steadily declines. Conventional assets must run just to stand still in that context. Over 25 years, what cost $4,500 can now command $450,000. In comparing returns, the S&P may triple, but gold can outperform it many times over. Silver's historical peaks, 50 in 1980 and again in 2011, should be inflated upward to account for currency decay. That suggests fair value well above today's nominal levels.
They decay in value every decade dramatically in real buying power because the quantity almost doubles for the dollar, for example, every decade, almost by 90% increase in the supply of dollars. So, like I've probably said this before, when your granddad built a house, it was $4,500 medium home price. Now it's $450,000. Okay, get the point? Okay, another way to express it is 25, quarter of a century years ago, same month, September 2000, if you bought the S&P, you're up 3.5-fold right now, okay? If you bought gold, you're up over 11-fold or 12-fold by now. It's held its value and stayed ahead of the decaying money unit that we use to measure things. Whereas some things have just barely kept up with it, like the stock market. Even though they look good on the price chart, it really isn't keeping up with the real value of the underlying unit. Well, silver was $50 in 1980.
While the macro backdrop is essential, the real drama plays out in price structure. Silver's ratio against its mining equities is pressing toward breakout. The miners may outperform both silver and gold. Momentum indicators, harmonic cycles, and trend confirmation all point upward. But the real foundation rests on supply-demand, global deficits, tightening inventories, and growing industrial usage. The World Silver Survey shows a persistent shortfall while solar, electronics, and energy demand are climbing. That union of technical force and real scarcity is rare and potentially explosive.
You want to try to compensate for that, for the real decay in the value of the money in it? Would probably be $200, $300 just to match that price in real dollar terms. Now, forget that. That's not a technical, that's just a fact. Silver's been vastly underpriced relative to gold, underpriced versus other metals for too long, and it's waking up. And when it wakes up, it's likely to have a tantrum. And the tantrum has only begun. We thought, based on one or two factors that I could identify, that maybe we'll find some profit-taking resistance in the 60-70 zone after we burst through the 50, run all the buy stops, the latecomers. Frankly, looking at more soberly and looking back in time, measuring this type of move, it wouldn't shock us that silver's in excess of $100 sometime in the first quarter. Okay. And getting there will be obviously rapid. We're in one of those phases now where silver's not only going to catch up to reality, catch up to what some base metals have done, catch up to gold. It's going to beat gold. It's already been beating gold this year. In fact, silver's up double digits more than gold's up year to date. Much of that occurring since April. Gold went into this, sideways, silver went vertical. Anyway, I think we're in an interesting time, and that's one of the factors in markets I'm most focused on personally.
Forecasting silver's trajectory is part art, part science. Analysts now see price resistance zones in the $60-$70 range after a rupture through $50. Some models, based purely on restoring inflation-adjusted parity, point to $200 to $300 territory long-term. But markets rarely move in straight lines. Pullbacks, profit-taking, regulatory shifts, or margin re-ratings can all push back. Exchange rules have intervened historically, notably in the 1980s and 2010s. Today, with a more globalized system, those breaks may be weaker, but they remain a risk.
Not sure of that. I know they could because technically we ran a spread chart, meaning divided the price of SIL, the popular silver miners ETF, against the price of an ounce of silver. And when you express that as a percent, you get a chart, okay? And it has technical attributes to it that suggests that you're pressing toward a breakout level right now, meaning a breakout in performance of the miners versus gold. And in contrast, for example, SIL right now is still $20 or so short of its 2011 price high, which was like $90 plus, okay? GDX, the gold mining ETF, is above its 2011 high, just like gold is, and yet the silver miners, just like silver, are below their 2011 high, and we can see the catch-up occurring quickly. And also, silver miners are at a point of breakout in performance, I'm talking about, versus the gold miners. So we're emphasizing silver. We think that it will outperform gold, and we think the silver miners will outperform the gold miners. And the question you're asking, will the silver miners beat silver? It's possible for a while. I don't think it's a big issue. I think the main emphasis that investors in the monetary mining sector should look at is emphasizing silver side of that equation. Just like in the bullion area, I'd emphasize silver. I think the percent gains you'll see there will handily beat gold over the next couple quarters.
The story is already unfolding. In 2025, silver is outperforming gold. Through October, it surged past $49 an ounce amid a record gold run above $4,000. HSBC has lifted its forecast for silver, while others cite tight physical supply, industrial demand, and safe haven flows. Yet some analysts caution that lease rates, inventory squeezes, and overbought indicators point to possible short-term cooling. The challenge now is distinguishing a healthy pause from a market reversal.
Reanalyzing closely the development of that upward process in the late 70s to the 1980 peak, and then also in the bull market that had been going on for a decade in silver up to 2010, and then suddenly it said, that's it, I've had enough. It went straight off the page. And it did it in what happened in both those markets, and this is true with other markets as well. It's not just looking back at silver. But when you go into acceleration phases in markets, what you see in the final couple of quarters, and I don't mean that we're going to top at that point. I'm just saying right now, the next couple of quarters is so dramatic that it drops your jaw. And it's not uncommon. In other words, when you get into these phases, and that is fairly uncommon, but it's not uncommon that when you get in those phases, you do what I'm talking about. And in terms of multiple gains, it's merely replicating and getting back to even somewhere near the real dollar value that it has saw in 2011 or certainly 1980. And also, like I said, certain other base metals and gold is well above its 2011. Why is silver the dog? Is it really a dog or is it a mistake? And I'm arguing this is one of these market mistakes that we see. And when they get exploited, they're worth exploiting. Undervalued, huge buy. Overvalued, huge short. And that's what I think silver's in right now, and I think it's going to compensate for it. But it's not going to do it in a way that is leisurely. Where, I'll have to think about this. Don't think too long. It's already said I'm accelerating. And I think the $50 high is a joke right now. That could come out in 48 hours or the next 2-3 weeks or whatever. But in the next handful of months, I think the move up in silver will be so dramatic that people they'll be jaw-dropping.
If silver truly enters its acceleration phase, participants have a rare window. Positioning matters. Bias towards silver versus gold and silver equities over bullion might yield outsized returns. But this is not a leisurely climb. Momentum can shift quickly. Watch structural supports on momentum charts, cross-market signals, and macro shifts like rate moves or policy interventions. Don't wait for perfection. Breakouts may precede confirmation. Finally, always build in risk buffers, because when market mistakes correct, they often overshoot, and silver may have only begun to compensate.
To restate what we've said before, the stock market is a major bubble in history of U.S. stock markets. No other bull market has had this kind of multiples over this period of time, and it is largely due to, look at an M2 chart, you'll see the growth, parabolic, and it's simply keeping up with the decay in the money unit. But and for 15 years, we've had free money 10 of those 15 years. And even when they raise rates to 5%, I'm talking the short end of the market now, and you go back 75 years and look at a Fed funds rate chart, even that 5% is in the lower quadrant of the past 75 years of rates. So we've had, in effect, what I call a Cheech and Chong rally, high on drugs the whole way. And a lot of that money flow went into the stock market to an excess. When those bubbles break, they're horrendous because errors are exposed, and you don't need a new headline to take it down, like a war in Europe or something like that. It will go on its own because it is done something excessive, just like we've been talking about regarding silver. It's done something that's excessive and prolonged, and when it makes up for it, it's dramatic. I think the stock market, by the way, right now, when we look at its metrics in the weekend report, we had I think it was a 100-day moving average oscillator. And it has structure that we're about to challenge right now as you and I are talking. About another 0.5% below where we are. You're going to trigger a structure that you cannot see it on the price chart, but you can clearly see it on the momentum chart. It's a floor that's been used like 4 times on momentum since July, whereas on price you have this upward incremental crawl ever since we got above the January, February highs in the S&P, which is like 6140. Everything since then has been like 0.25%, 0.5% week, et cetera. Incremental, yet new highs. But during that time, momentum has built a floor that says, you break me, I'm going to take you down. Now, The problem is if you're long the stock market, we're arguing we've been in a developmental top process since late last year. Yes, new highs that occurred in 2000, mid 2000, after we predicted a high in January. It occurred in October of 2007 after we'd predicted high occurring at a certain target zone. That was a Fed rate cut that helped cause that high, just like we just had. You don't want to get back below the prior high. Well, for the S&P, that's 61 plus. Right now, we're pushing towards 6,600. Well, we're talking, not a lot of percentage points. So if you get an intermediate term break in the stock market, everybody says, oh, that's fine. You don't want to get back below that January, February high, because if it does, then you're saying, oops, that wasn't the breakout I thought it was. It's a failed launch. That's when you get into the deeper stuff. And I think that's likely to occur. And when it does, it will have wave effects.